Hi, everyone. It's Anthony Caporrino here again. Today, I'm here with my partner and co-leader for the U.S. Transaction Advisory Group at Alvarez Marsal, Stacy Kirshner. And today, we're going to have a discussion around private equity and M&A trends that we saw in 2025 and some of the things that we expect in 2026. So, Stacy, great to be here and looking forward to having the discussion.
Great to be here, Anthony.
First topic, as we move from 25 to 26, how would you describe the overall shift in sentiment around private equity and M&A, and what feels different potentially in 26 relative to 25?
Sure. So the dust seems to have settled on 25, and there seems to be this renewed confidence in the deal making environment. Private equity is entering 26 with a new level of confidence. We're seeing sell side activity start to go to market. We're continuing to see the buy and build strategies be active, and investors are committing capital with clear regulations, declining interest rates, and strong momentum from AI. But there are some risks that private equity will face in 26, certainly around political noise, AI-driven investment thesis, and sector-wide structural changes. But taking a step back, and as we head into 26, we're excited about a busy year of deal making.
Yeah, I would agree. I think last year at this time, there was that level of excitement, and then the market didn't necessarily pan out the way we all thought, but it feels a little bit different now as we're sitting here in early January around what people are doing currently, what we expect, and just general sentiment. So we'll focus today on a few industry verticals: energy and infrastructure, technology, financial services, healthcare, and just discuss how some of that sentiment is going to play out.
So, Anthony, looking back at 25, we saw a market that was certainly defined by technology, M&A. And we started to see healthcare, M&A rebound, and starting to see some shifts in the market due to regulatory, shifts, and starting to reshape the M&A playbook, both for private equity and strategic buyers. How do you think these industry sectors will perform as we head into 26?
Sure. I think in general, no matter what the industry, AI and technology has a backdrop, and in some ways is really driving some level of activity. We've seen in our business, we're in the midst right now of deals in software and technology, in healthcare, in financial services that have some level of technology behind it. And generally, the way we've gone at it is a joint effort between our industry vertical teams. So in financial services, pairing our financial services expertise with our technology expertise, because that's just the way the deals have been comprised. And our clients are calling us with interesting deals, but ever more complex. So there's that backdrop of technology, no matter what the industry, and I expect that to continue. When you look at software and technology, that's been a case where a couple of years ago, valuations were down, things were slow, and that certainly has picked up. And there seems to be an increasing amount of activity over time for technology deals. I don't know that the valuations are back where they were, say, 4 years ago, but they're healthy valuations. There's a lot of optimism around S&T, and we continue to see that level of activity ramp. And I would venture to guess that's probably going to be the case for the better part of 26. When you look at healthcare, I think healthcare is interesting. We've seen also similar backdrop, a lot of healthcare technology type transactions. I think the market has shifted a bit from practice and physician management to more life science, pharma, that health tech combination. And I think that's been an exciting area that a lot of funds are beginning to explore. Certainly, there's the large biotech corporations that play in the space, but private equity has continued to morph their healthcare practices into more and more of a healthcare life science. And we've done the same with our level of expertise. But I think looking back to last year, a lot of regulatory scrutiny within healthcare. I think that in some ways perhaps maybe hasn't subsided regulatory wise, but the market has shifted a bit uh, with private equity where they're looking at other things that are a little bit less prone to some of the scrutiny that was the case, say, a year ago. Regulatory point of view, I think there's been a more favorable environment since the new administration has come into play. I think that's going to continue. Again, it's mixed. I think in general, there's a appetite for more merger and acquisition activity and acceptance, if you will. But again, it depends on the situation. If you look at a Warner Brothers, Netflix, Paramount situation, I think there's appetite for some type of merger, but it's a question of which one is best and which one will get scrutinized less. But in general, there's a much more open mind about mergers and acquisitions. I think that has and will impact 2026 in a good way. And then lastly, as I said before, AI continues to be front and center, no matter what the industry, no matter what the company, a lot of heavy investment. I think this year is going to be more of a situation where there's a lot more application and perhaps application catching up to development. And we see that in a lot of the businesses where we're looking at. We see that in our own business. I think private equity in general, that's the case. So I expect that to continue to propel companies forward, and a situation where you're going to have to answer the question, how are you now starting to apply AI, and maybe less about have you developed or how much have you developed AI and spent from a monetary point of view.
Yeah, completely agree. Particularly on the points around AI, Anthony, its impact and dominance within deal making right now just provides for a new level of requirement for deal making discipline that many of our clients have not really had to consider before. So I think we're certainly entering a very interesting year and years to come, and how this will impact valuations and also, how you evaluate assets in the market.
So Stacy, moving on here, as we look into 26 and we talk about global M&A, what's your views on the outlook and the overall sentiment that will define global M&A in 2026?
Yeah. So Anthony, we're off to a pretty strong start in deal making around the world in 26. Companies and investors are finally moving forward after waiting on the sidelines for a number of years, which is certainly fueled by the strong stock market and stabilized interest rates. The headlines are big return of larger acquisitions and are making a comeback, which is certainly showing a renewed confidence. But many buyers are focusing on steady growth, so adding smaller companies that fit rather than betting everything on one massive deal. Investors are also prioritizing, as we've discussed, specific sectors, so technology, healthcare, energy, and infrastructure. And AI is really kind of the key theme of the year, and how that's going to be impacting opportunities in the market.
Yeah, and I think as the larger deals come back into play, I think that just has a trickle down effect in general. I think over the last couple of years, you've seen a little bit of pressure where some of the larger funds started to move down market in search of opportunities, just given that there wasn't much of a play for some of the larger acquisitions, as you just mentioned. But now, I think, given some of the shift, that'll certainly not only help large cap acquisitions, but I think it'll help the middle market as well, as there'll be more traditional middle market players looking at middle market deals and not necessarily having the level of competition that perhaps they had from larger funds over the last two years or so. Stacy, as we move into the more industry focus here in the discussion, why don't we talk about energy and infrastructure? Over the last couple of years, that's been a bit of a slower market, at least here in the US, as we've seen. What are some of the trends and sentiment going forward in 26 relative to E&I?
Sure. We're seeing investors become much more confident about putting money into the US as it relates to infrastructure. This is mainly because the government is strongly backing artificial intelligence, which has made things like data centers, cell towers, and related facilities especially attractive. On the flip side, renewable energy projects in the US are less popular because of policy changes and fewer tax incentives. Political instability will be the biggest barrier here to investment in infrastructure. So looking ahead, investors are watching that pretty closely over the horizon, but investment in data centers and how that will shape the energy transition is certainly where we expect the most activity over the next 24 months.
Yeah, I would agree. I think when you look at energy and infrastructure, it's interesting because of the large AI focus and then the related infrastructure build on data centers that's necessary to power AI. I think we've seen the true definition of E&I deals expand. So you have the core infrastructure and construction type deals, but then relative, for example, to data centers, you have all these other ancillary services that come into play. So the power delivery, the water necessities and requirements. And there's a level of, I think, general business services that have rolled up into energy and infrastructure that I think in years past you hadn't seen. So that's a good thing for the industry as a whole. And there are large and many angles that some of our investor clients have taken that ultimately expands the presence of E&I. So that bodes well for the general market. It bodes well for us, and I think overall we'll continue to see that, as you've said, this year as well as a few years out into the future.
So, Anthony, as we look to 26, we've seen strong momentum within the software and technology industry. How is private equity's focus within this sector becoming more targeted?
So, Stacy, software technology, as we know, and we've talked about a few minutes ago, has really increased in activity here in the US, certainly for our business over the last couple of years. When you look at our business, it's roughly a quarter of our transaction volume. It continues to grow. And I think when you look at the various components and areas of the broad software and technology market, in late 2025, here in 2026, there's focus on SaaS. There's a heavy focus on gaming, and we've seen some larger strategic deals over the last couple months in the area of gaming. There's obviously all of the technology around AI. So those all bode well for a year that really should excel, both volume-wise. I would expect value-wise the same type of trajectory. And as you get into further specification in the industry, that'll just, I think, propel everyone up. We talked a little bit about how there's been a focus in healthcare technology deals, in financial services and technology deals. So I think there's been uh, much more of a, a broader net relative to a few years ago when it was entirely SaaS. Now you're looking at various types of technology investing that most of our clients are doing, and the area of expertise necessary to complete those deals, I think has deepened as well. But I would expect to see a lot more in gaming and a lot more of the combination of industry and technology deals going forward, which should be uh, a situation that just propels all of technology-focused investors. And I would also expect, as we also have seen in the past, generalist type PE funds getting into the space in light of the dynamics and the economic profile, which has happened before, and I would expect that type of situation to happen again.
Yeah, I would agree, particularly as it relates to new entrants in the industry, as it relates to software and technology. Even investors adding a software and technology component to a financial services platform, healthcare, et cetera, to really round it out, as well as, enhance it from an efficiency, as well as take it to a new technological level.
Yes, I agree.
So, Anthony, as we think about some of the key themes within tech, why are cybersecurity, particularly operational technology, and AI-related safeguards becoming such a focal point for the sector in deal making?
That's a great question. I think in general, when you just look at any period that has disruption, obviously with more disruption, there's greater chance for things to happen. There's higher risk. So as AI becomes more sophisticated, as there are more needs around, as we discussed before, power and water delivery, the grid becomes a lot more important. And so, in order to keep those things safe and free from cyber attack, there's a heightened focus on cybersecurity and the technology around keeping those, I would say, macroeconomic factors safe. And so, again, with each area of focus, there's almost a compounding effect that brings everything else along with it. As people continue to use their mobile devices for more and more activities, there's heightened risk around hacking and how that could disrupt a financial transaction, how it could disrupt cell service. So as technology continues to support that, there will be opportunity to engage in M&A activity around security and cybersecurity. That said, the level of innovation and the pace at which AI, for example, is moving, it's probably outpaced some of the levels of security that are ultimately existing right now. And so opportunity to develop further specifications and expertise within the security creates opportunity. And uh, therein lies, I think, a lot of the optimism around securing a company. If you're a private equity firm that has a niche in cybersecurity, has some type of offering that can bolster the broader economic profile of a certain area or asset. So we've seen that in our business and some of the targets that our clients are going after. And I think that will continue to come into play and really almost changed on a daily basis as the development within technology and AI becomes more and more rampant.
Completely agree. And, I think what we're seeing now is areas such as cybersecurity in the deal making process during diligence is a critical step to understand the cybersecurity environment, the potential investment areas that will need to be focused on post transaction. Whereas, several years ago, that was, maybe an area you would see focused on every 10 deals. So certainly seeing an increase in focus as it relates to cybersecurity.
I think as people experience, unfortunately, the ramifications of a cyber failure, if you will, it really opens your eyes, whether it's air traffic software, again, as I said before, cell service, utility interruptions. The more that happens and impacts a large swath of the population, hence the need to keep those things safe. And therein lies, I think, that the opportunity for the technology to continue to develop, and then obviously the focus on obtaining assets that can create that technology even more important. Stacy, why don't we move on to financial services? How is deal activity in traditional financial services and maybe even a bit more specifically banking? How is that shaping up for 2026?
Yeah. So, Anthony, we're expecting financial services sector to be another busy year. In the traditional spaces, private equity continues to be very busy in sectors like asset and wealth management, insurance distribution, really your highly recurring revenue stream businesses. We're also seeing a spike in increased activity in the banking sector, as you mentioned. And really, this is a result of some regulatory victories that have greased up the wheels for M&A activity to happen, allowing institutions to push through deals at volumes that we haven't seen in over a decade. So pretty exciting times for the industry and opportunities for bank-to-bank deals, as well as private equity to invest in the space. Probably the most dynamic area, though, within financial services is private credit. Certainly a risky area, but investors that really understand it are willing to place some bets here. This is going to be a popular area within the financial services space as we head into 26.
When you say some regulatory areas that have impacted, it sounds like positively financial services. Just in general, what are some of those that regulatory issues that you're referencing?
Sure. So, I mean, we're seeing, the reserve limits change, mergers of, some of these larger banks allowing to access, mergers within some of the smaller banks. And some of the interest rate declines are also allowing for some of this bank-to-bank mergers to happen. So, the landscape is there. There's certainly challenges and regulatory approvals that elongate the process, compared to other industries. But, again, as we think back over the last decade, it's certainly seeing a tick up in volume compared to previous years.
So, Stacy, you referenced private credit a little while ago. That's an area that has seen tremendous growth in recent years. Why has it become so attractive to investors and private equity in general?
So we're seeing private credit become more popular with wealthy individuals to large institutions, and it's really driven by the returns that it pays, as well as interest rates that have been a little volatile over the past few years. For private equity firms, it creates a credit fund that can be particularly valuable. It generates a reoccurring revenue stream for them, but also an opportunity to getting deals done. They can use this for their buyout funds versus going to a traditional bank for lending.
So you mentioned a lot of the benefits of private credit. There's also, in some minds, a ton of risk, depending on what view you take. What challenges are resulting from the overall prevalence of private credit?
Sure. So, despite the boom and a number of private credit funds being created, there are some cracks forming within the industry. The rapid expansion within private credit means many loans were issued to companies that candidly are struggling in a prolonged high rate interest rate environment. So forecasts are indicating that the rise of private credit could also actually create a restructuring opportunity in 26. So this could present an opportunity for distressed debt investors. PE firms with restructuring expertise will find ample opportunity to acquire assets at a discount, and take control of some of these companies through debt to equity swaps. You know, ultimately, it's something that's going to require a disciplined approach, a significant level of diligence, but for the right investor, it creates a significant amount of opportunity.
Yeah, I know in late 25 there were certainly some high profile examples of the private credit risk profile. So we'll see how 26 shakes out, and hopefully there aren't more of that nature, but there certainly are benefits, but a lot of risk as well, depending on the specific situation that people have to be mindful of.
Anthony, let's talk a little bit about healthcare and life sciences. We've seen a bit of a cautious period for some time in the M&A market. How is healthcare and life science deal making evolving as we head into 26?
Yeah, certainly as we got into 25, there was a much more measured approach around healthcare in general. As a result, as we previously discussed, some of the regulatory scrutiny, I think some of the challenges that private equity had with physician management practices and the ability to integrate them. But that said, when you look to 26 and as 25 continued to progress, and now that we're into 26, there's been a lot more focus around automation in healthcare, a lot more focus, as we said, around pharma, life sciences. There's a lot of increased activity and interest in medical devices. So when you look at healthcare in general, it's particularly here in the US, it's a broad market. The demographics of the population would support increased healthcare activity. And when you look at the ecosystem, anything that rolls up into that long term would be attractive from a deal making point of view. When you start to break that down into more specific areas, you see continued innovation around medical devices, technology, and how technology is making medical exams better and quicker and easier. So we've seen that now as we get into 26 become much more of an area of focus. And then on the pharma and life science side, that continues to be an area of evolution, whether it's a compounder, which I would say is probably maybe a space where a healthcare investor who is maybe new into the industry takes a look at the continued evolution of drugs in certain areas. Again, increased traction given how that industry innovates. So the area of healthcare continues to expand, but the bedrock of it and the demographic profile would continue to support broader healthcare in general. And much like we talked about with energy and infrastructure, the more that expands, the more these ancillary areas around healthcare come into play, and the more then private equity investors look at various areas. And we've seen that. And 26, I think looking back at 25, it certainly wasn't as slow as maybe we would have anticipated. and that's a good thing. But again, probably more a result of some of the shift in focus, and that shift will now continue into 26. And we expect healthcare to continue to be very active. And for us here at A&M in the U.S., it's a big part of our practice. It continues to be an area where we field calls consistently, and we look at opportunities that that many clients are attracted to.
Yeah, I would agree, Anthony. The opportunities within healthcare are expansive. We've certainly seen deal activity pick up in vertical integration as well, and ways for these healthcare companies to integrate the value chain into the business, as well as technology. As you said, I mean, many of these organizations are operating on archaic systems, and how can they work more efficiently with better data? And that will really start to set some of these businesses apart from others, and certainly drive up valuations for assets compared to their peers. Anthony, we talked about a number of opportunities within the healthcare sector as it relates to deal making. What are, if any, potential headwinds in the market as we head into 26?
I think there continues to be headwinds around regulatory scrutiny in the U.S. when you look at some of the bills that were discussed and passed in California. Most of that around physician practices. There's definitely the perhaps stigma of private equity around healthcare that may not be as positive as some other industries. That said, in order to mitigate some of that, there's been a shift in other areas of healthcare, as we've talked about. Technology. There's a lot more focus on private pay and parts of healthcare that perhaps aren't covered by insurance, whether that's for aesthetic reasons, medical practices, or exams that are perhaps a little bit innovative and maybe haven't yet obtained all the regulatory approvals that are necessary. They're more experimental. There's focus in those areas. So I don't necessarily view the regulatory risk as a negative thing in totality, because it has allowed private equity and many of our clients to explore other areas of healthcare that maybe they otherwise would not have had. I think ultimately the scrutiny around physician practices probably will subside, and perhaps we see that come back at some point in time. But there's been a pretty quick shift of focus to other areas that, quite frankly, could be more accretive and are a little bit easier to navigate. Certainly, if you're in an area that's more private pay focused than insurer pay, and perhaps also ones that are embedded with inherent technology that is easier to manage and more predictable when it comes to revenue streams and growth. So I would say it's somewhat of a mixed answer. It's maybe a bit more negative on one hand, but on the flip side, I think is a little more optimistic, because new areas of exploration continue to result in increased opportunity for investment and ultimately profitability.
So, Anthony, it's been great to just take a step back and reflect on 2025, but also really get energized on what's expected to be an exciting 2026 of deal making. What do you think will be the key areas for private equity as it relates to investing and as market interest for the year?
I think in general, stability is always a factor, and that's pretty straightforward. Everyone understands that. But last year was a year for the most part of instability when you look at whether it was policy, geopolitical actions and events, and that really impacted the overall level of investment within private equity and M&A, and certainly, within the US in our areas of focus. I think with more stability in 26, hopefully that just brings a little bit more comfort to private equity to operate in a more stable environment. Now, that said, there's many things going on currently that may shift that comment, but hopefully 26 has a bit more stability in the US, around the globe, that allows for more predictability when it comes to business performance. And so I would say, looking towards stability, that'll create interest, it'll create activity, and assuming that happens, it'll be busy for everyone. And we talked about 4 industries here of focus that would benefit from that. I would even add, if you look beyond those industries, in areas like consumer and business services, I think a lot of what we said holds true for those industries as well. So I think everyone expects a good year for private equity in general, regardless of the industry focus. But again, that all is stipulated on more stability and a bit more predictability.
Yeah, I completely agree, Anthony. The instability from last year just continued to drive a level of pent-up demand and opportunities for 26 deal making. But as you said, there's some areas of risks that is going to require investors to be extremely disciplined. And the level of diligence and assessment is just expanding, and need to be very disciplined, and how you're thinking about opportunities and increasing complexities, how technology is going to impact the investment thesis. But all in, I think we're extremely excited about an active year, and looking forward to diving right in.
Well, Stacy, it was great to talk to you here and exchange some thoughts and ideas. And I think you and I both are optimistic for our business, for A&M in general, and for our clients. So thanks everyone for listening, and we'll see you again soon. Take care.